The ins and outs of hedge funds. Investors have enjoyed calm waters for many years, but they're now facing potentially higher market volatility. Given the global, economic and geopolitical situation, it's easy to see why. Traditional investment portfolios may be challenged by choppy financial waters, which is where hedge funds come in. Hedge funds can exploit opportunities in ways that traditional investments cannot. Indeed, when markets are volatile, hedge funds most often make the most attractive investment opportunities. How they work. Hedge funds tend to have greater investment latitude and engage in markets differently. Some employ strategies designed to profit when stock prices fall, whereas others take advantage of price inefficiencies. Leverage is also key. These funds use derivatives or borrow money to increase exposure, which means they may improve their performances if their expectations are correct, but may be exposed to losses if not. Broadly, hedge fund investments fall into three categories. The first is fixed income alternatives, which have a similar risk-return profile to traditional fixed income with limited sensitivity to bonds. The second is diversifiers to traditional assets, which use different asset classes to provide attractive risk-adjusted returns with low correlation to bonds and equities. And the third one is asymmetric equity, which provides exposure to equity markets with less volatility and limited sensitivity to markets. In this case, the aim is to capture equity markets' upsides while limiting the downsides. How to invest. The best way for investors to access hedge funds is through organisations or teams with experience and industry contacts who can put together a portfolio that matches the investor's risk-return profile and liquidity needs. Experienced investors can invest directly in single funds. They should do this via liquid and regulated funds, such as alternative UCITS. The key is knowing what role a hedge fund investment plays in an overall asset allocation. Hedge funds' objective is to produce attractive risk-adjusted returns using techniques that are not available to long-only funds. Investors should also bear in mind that, given some of their characteristics, such as use of leverage, concentrated bets, and limited liquidity, hedge funds tend to be considered relatively risky. To deal with these risks, there are two main challenges to consider. The first is selecting the right manager. The second is diversification, and investing in a variety of hedge funds may not be enough to achieve proper diversification. So before investing, a thorough risk analysis of the overall portfolio is strongly recommended. To find out more about the current sweet spot for hedge funds and how to best navigate the risks and opportunities, visit ubp.com.